Okay, now I'm going to show you something about where to get free stock picks on the internet. I usually ask people if they've ever heard of someone named Benjamin Graham, and well, chances are not many people have ever heard of Benjamin Graham. So then I ask them, well, have you ever heard of Warren Buffett? Well, pretty much everyone's heard of Warren Buffett. Warren Buffett went to New York University and attended a class taught by Benjamin Graham. And Benjamin Graham co-wrote a book in the 20s or 30s called Securities Analysis. And that has been, well, probably one of the most important books ever written on the subject of investing in stocks. They're well known as value investors. In other words, they look for companies that are overlooked and undervalued. And you know, that's Warren Buffett's real strategy. So we're going to look and take a look at what his mentor had taught him. I happened to come across an article written, I'm not sure how long, maybe 30 years ago, if not more. Just a 4-page article written by Benjamin Graham. He says, this is what I look for when I look for an investment. Specific things I look for when I go out to pick a stock. Well, I took a look at that article and I thought, well, you know what, I bet we could do the same thing here, but there are some online resources we could use, some online databases that'll make the process a whole lot faster. Now, this is the best one that I know of that doesn't require any kind of fees or you have to download anything to your computer. It's www.zacks.com, Z-A-C-K-S. Zacks is a very well-known investment management company. So this is their homepage at zacks.com, and from here, across the menu bar across the top, near the right it says Screening. So if you click on where it says Screening, and that'll take you to the screening page. Then there's a darker green bar below that. The one furthest left it says Custom. Click where it says Custom, and we'll come up with an online tool that you can fill in the blanks right here. This is in 2 columns. On the left column, it gives you certain criteria to look for. And then on the right-hand side, the more specific things that you'll put in and the exact numbers that you'll use to put that in. So I read Benjamin Graham's article and I thought, well, let's go to this website and just take what he's looking for, plug and chug the numbers, and let's see what we come up with. So first, we click on the left-hand side, we go to where it says EPS estimates. That stands for earnings per share. He says he likes to find companies, of course, that are growing their earnings. He'd like to see earnings that have grown at least 7% per year over the last 5 years, at least on average. So the very top one, it says annualized 5-year historical earnings per share growth. So we want to see their 5-year growth. Now to the right of that is a pop-up menu, and I can choose from there greater than equal to or less than equal to. Now, he said in his article that he wants companies earning 7% per year on average for the last 5 years. So on the top line, I'll leave that as greater than equal to, and I'll type in number 7 in on the right-hand side. Then I'll come down to where it says last year's growth. He said he wants to find companies whose last year earnings they've earned at least 12% over the last year. Their earnings have grown 12%. So last year's growth, I choose greater than, and I type in a 12, 1, 2. Now to the right of that, I just click on where it says Add. And what it will do, once I click on that, it will bring that to the top. Here are my first 2 criteria at the very top. The 5-year earnings growth greater than 7%, last year's growth greater than 12%. Now it's told me how many companies in its database have met those first 2 criteria. There are 992 of them. Next thing I look for is where it says Valuations. I'll click on Valuations. So that's what it looks here. For valuations, now remember that Benjamin Graham and Warren Buffett are known as value investors. So they want to buy low-priced stocks, or stocks that are trading at a discount to their intrinsic worth. One way of measuring that is by measuring the PE, or price to earnings multiple. So they're looking for stocks that have been trading at no more than 20 times their earnings in the last year. So if they made $1 per share, for example, after all was said and done, they'd want to see it trading for $20 or less. So I'll go over to PE, I'll change the greater than, I'll use that pop-up menu, I'll change greater than to less than or equal to, type in a 20 to the box next to that, and click on, and then click where it says Add. At the top of the screen, we now see that there are 884 companies that meet all criteria. Next one I want to choose is at the bottom. I'll choose dividends, because he says he likes to find a company that pays a good dividend. He likes to see a dividend that pays at least 3%. So in the top line, current dividend yield, I'll keep that at greater than equal to, and I'll type a 3 next to that, and I'll click where it says Add. I'll go to the top, Well, that's cut the field down a little bit more. There are now 167 companies that meet all 4 of these criteria. Next, we're going to go down to the bottom and choose liquidity and coverage. So we'll choose that. Now he wants to find a company that's in a good cash position. So he'd like to find one. He goes down to where it says current ratio. That's the 3rd one down. Current ratio greater than 2. Current ratio means current assets to current liabilities. In other words, he wants to see that they've got at least $2 in cash for every $1 in bills. By the way, if you ever need a definition about what these mean, notice there's a little question mark just to the right of this criteria's name. So you point your mouse over the question mark and it'll come up with a definition. So I put a number 2, I click on the button that says add, and then it tells me there are now 42 companies that meet all these criteria. Next thing we're looking at is where it says price and price changes. You'd like to find a company that has a little less risk overall. It's a little less risky. One way of measuring risk is by measuring its up and down volatility as compared to the market overall. So I choose price and price changes. In the middle, I would choose the one that says beta. Beta is a measure of volatility. By definition, the stock market has a beta of 1. So anything with a beta less than 1 is less volatile than the overall market, and more than 1 is more volatile. We're going to go to beta, choose less than equal to, and type in a 0.9. So we want to see something that's 90% or less as volatile as the overall market. Click on the button, so I'll change that there. I'll click on the button that says add, and now it tells me, if I go to the top, there are now 16 companies that match all 6 criteria. Now I'll just click on the button at the top that says run screen, and I'll find out what those companies are. In fact, there were a little bit more companies than I had room to put on this demonstration. But here are the companies that we're looking that now meet all these criteria. So here's a question for you. How long would it have taken Benjamin Graham in 1935 or 1938 or even in 1974 when he wrote that article to have come up with this list? As you see, we're able to do what he does, and once you get the hang of it, you can get Benjamin Graham's picks in under 3 minutes. Now, you're not quite done here. What you want to look at, well, you'd like to eliminate anything that, well, pretty much looks too good to be true. If you saw something that had a 5-year earnings or a last year's growth that was just off the charts, and yet they're trading at less than 20% of their multiple, well, either that's one of the most overlooked stocks ever, in that case they need to hire a new PR company, or there's probably more going on than that. And if you go down, if you check out their news and earnings reports, you'll probably discover that they probably sold off assets to account for that big earnings spike in earnings. So it's not because they're doing that much more business. But if we take a look at what we have to choose from, we'll notice, for example, in the column of current dividend yield, we're seeing some pretty decent dividend payments. 3%, 4%, 8%, 12%, even one that's paying over 26% dividend. Many of them are in very good cash positions. As you see, some of them are quite low volatility and have had very decent earnings results. Next thing you want to do is you want to click on any one of these ticker symbols here, and you can pull up, say, this would be a report on the company. From here, go over to the menu where it says Jump To on the right-hand side. Pull up that pop-up menu from here, and then you choose Company News from that list of pop-up menus. And in this particular case, there wasn't much in the way of company news, but there's always other sources if you want to learn more, if you want to see their last earnings reports, for example. But this medical properties, for example, is a real estate investment trust, so they were paying a pretty handsome dividend. So I thought it might be worthwhile checking them out and seeing if there was any more to this going on to the story. So at this point, again, you want to dig a little bit deeper, certainly, and find out, make sure you eliminate anything with any kind of extraordinary items. So if it had a big spike in earnings, for example, make sure that wasn't because they sold assets or had any kind of extraordinary event. If they pay a high dividend, just double check and make sure that they didn't have some kind of one-time special payout to their shareholders. So that way you'll make sure you have the best types of investments that you can find. And that's how Benjamin Graham would go out and pick overlooked, undervalued companies. For more information about how to use the best websites to manage your 401k, please go to www.401kseminar.com or call 480-860-0226. Thanks. I'm Richard Victor.